Hi, good morning, everybody. You're taking a look at live shots of the opening bell on Wall Street on this Tuesday morning. Blue Owl ringing the bell down at the NYSE, while Crinetics Pharmaceuticals getting things started up at the NASDAQ market site. Welcome to Opening Bid. I'm Myles Udland, in for Brian Sazi, who is on assignment on this, the final day of the third quarter. 75% of 2025 will be in the books at the close of business today. If you are behind on your New Year's resolutions, it's too late. Time to start planning for 2026. Find something else to get excited about as we look to flip the page on this third quarter. All right, let's get a quick check on the major averages as we kick off trading. Let's send it to Times Square, where our own Allie Canal is live from the NASDAQ. Allie.
Hi, Myles. You're having me thinking about my own New Year's resolutions, but you're right. If you haven't started yet, time to get going. And we're seeing all the major indexes open pretty much flat, slightly to the downside there. Dow is trading essentially flat, oscillating between the top line and the bottom line. NASDAQ down around 0.1%. Same with the S&P 500. But the story here is really about the end of the third quarter as we gear up for Q4. And to that point, if we take a look on a sector basis, it's really interesting to see what's led the gains so far. And look, it's tech. Once again, it's just a consumer discretionary. You're seeing consumer staples in the red quarter to date, down 5%. This is something we're going to be drilling into throughout the show today. But clearly, investors are in risk-on rally mode, not seeing any type of slowdown, even with that government shutdown firmly in the minds of investors. If that does happen, we will not be receiving that non-farm payrolls report on Friday, and that is clearly an important factor for the Federal Reserve as it weighs its upcoming interest rate decisions. But I also want to take a look at some specific company news and what's trending this morning on Yahoo Finance, because you're going to see Spotify shares off around 3%. Now, this comes after the company announced that CEO Daniel Ek, longtime executive, he is going to be stepping into the role of executive chairman effective January 1, 2026. Now, taking the reins here, I should say, is going to be Gustav Soderstrom, Spotify's head of product and technology, along with Alex Newstrom, the company's chief business officer. They will both share the title of co-CEO. And it is interesting to look at the tech landscape, in particular media, because we have seen those dual CEOs come out more and more. Now, on today's investor call, the pair joked, quote, "You get twice the brain," but they did emphasize that they would both be focused on their individual roles. So just a pivotal moment for Spotify, which has seen just an aggressive run up over the past few years as they worked to pivot their business to profitability on a year-over-year basis. Shares are up over 90%, Myles.
Yeah, Allie, on the Spotify point, the other thing, too, with Ek moving on is that you have another large company losing a founder CEO, which is rarer and rarer as we see companies stay private longer and longer. You think of, I think of Dylan Field over at Figma, founder CEO. And so that, to me, feels like the biggest piece of news here as well. I mean, longer term, right, as we start to digest what this means, for that company.
Absolutely.
All right, and I said, not time to start. You got to move on with your resolutions, by the way. You got to get new ones for 2026. You can't, whatever you had, 25's over.
I have them in my back pocket.
All right, 25's over. We'll talk about this offline. All right, let's take a look at three things we are watching this morning as this final trading day of the quarter gets underway. First, the U.S. is on the brink of a government shutdown. Once again, stocks tend to take these situations in stride, but with consequential economic data on the line, could there be a bit more uneasiness this time around? And an inactive government would mean no jobs report and on Friday, which may add a bit more heft to some of the other labor market data we're getting this week, including job openings data due out in about 25 minutes or so. Plus, our panel of experts will take us through the biggest risks to markets through year end. Joining us now to break it all down, Omar Aguilar is the CEO and CIO at Schwab Asset Management, alongside Yahoo Finance senior reporters Allie Canal and Inez Ferre. Thank you guys for jumping on this morning. Omar, I want to start with you and just your thoughts on the impending government shutdown. It seems likely to happen tonight at midnight. We've seen some estimates from firms across the street could last somewhere on the order of a week, maybe two. Just curious how you've thought through this period, with your own team, talking about it with clients, and not the first time we've seen this. And so what does your work suggest investors need to do through these periods?
Well, to answer the question, the investors need to do nothing. I think we have had discussions with clients over the last couple of weeks about what they do if the government indeed shuts down, and the reality that there's really nothing they need to do with their portfolios. We will see volatility. Really, a lot of the uncertainty will be related to the length of the shutdown. And as you said, this is not the first time that this has happened. And a lot of these will be, how much this will be dragged. With the implications really more about, what would be the data that we will miss, and specifically what would be the data that the Fed will miss in order for them to use or update their models in anticipation of their next meeting. So that will create volatility in the short term. I think once this all gets cleared out, things will come back to normal.
Omar, to follow up on that data point, so we may not get, it's likely we're not going to get the jobs report this Friday, but that report comes at a time when it feels like the monthly jobs report hasn't been questioned this much, so far as I can remember, where you had the massive revision 2 months ago, you had changes at the top of the BLS. Does that, to you, speak, have you had any thoughts, I guess, around whether the monthly jobs data is something that we start to react to less, just given the nature of this report? It's one that does get revised. I know from, over the years, many people have said, we're overreacting to it anyway. Is there maybe an opening here to further that conversation and maybe have markets, look a little bit less acutely at that first Friday of the month?
I would hope so. I certainly hope that, investors and in general market participants can put less of an emphasis on one data point and instead look at the trend and look at the underlying components that make that data. To your point, it is very common that, monthly numbers get revised. They're not perfect, in terms of data. There's a significant amount of ranges of potential outcomes that they come with it. I think what is more important for investors and for investment strategies is to look at the direction of travel. What is that trend and where does that go? And today, regardless of whether or not we're going to have a data point on Friday or not, we do know that the data on unemployment and data on the labor market will continue to show softness, will continue to show, parts of the markets that are starting to just see some cracks. And at the same time, while the unemployment number may stay, so in the same place that they have been for the last few months, I think looking at the underlying components that what make up that unemployment number is important. Immigration plays a role, demographics, plays a role, and I think participation rate and a lot of the details that go behind that is actually more important than the actual number itself. Of course, a lot of what we all pay attention is of the headline number, but I think that creates volatility and uncertainty that is reflected in markets right away.
All right, we're seeing markets just lose a little bit of ground here as we get started with the trading day. Inez, I want to go to you next on some commentary that you've seen from across the street around the shutdown. And I think it just opens up a conversation for, for strategists, for folks talking to their clients to talk a little bit differently about how we're wrapping up the third quarter. I know later on we're going to talk about what to expect in the fourth quarter, but just curious what you've seen as you're kind of getting dug in here on this Tuesday morning.
Yeah, just taking a look at some of the commentary that we've seen. Look, UBS is basically saying to investors, just look past the fears of a government shutdown and focus really on the drivers that we've seen, the big themes that we've seen this year. That is the Fed rate cuts. That is going to propel the markets forward. They're also talking about AI being the big theme as well, and also strong corporate earnings. So they're basically saying, look past this, stay the course. UBS expecting 6,800 for the S&P 500 by mid-2026, and in a bull case scenario, they're even talking about 7,500 for the S&P 500. And they're even saying, look, we know that we've seen that the markets are at record highs. So they're saying, use the pullbacks, use any dips to add exposure. One other interesting commentary that I saw this morning also from a quick blurb from Goldman Sachs is basically they were talking about a key risk to the economy being the labor market. That is really the risk. But if the economy can continue forward, given a slowdown in the labor market, then the market will look forward towards next year. It will look at the Fed rate cuts that are coming, and the tariff uncertainty that we've seen this year, that is going to be replaced by tailwinds of fiscal support, tailwinds of the Fed cuts, and the big beautiful bill that is going to be, you're going to be seeing the full impact of it next year.
And as you were talking there, and we showed the three major averages, and you talked about, strategists saying, oh, use any dips to buy. There really haven't been any dips in like 3 months, 6 months. I mean, you look at how shallow those pullbacks have been since April, and I think it's a conversation as we get towards the end of this year and we reflect on the totality of 2025. You had one shot, right? You had a couple weeks in April. That was your big dip. Other than that, it's been pretty much, VIX is in the mid-teens, right? So it's sort of that environment again. Let's stay on the data point and talk a little bit about the economy. We're going to get some data in about 20 minutes, Allie, on job openings. We saw last month, so this data is in a 1 month lag. So we're going to get the August numbers this morning. We got the July numbers at the beginning of this month. But we are seeing now the labor market really in its softest spot since the pandemic, and even if you back that out, because there was a lot of goofiness around the pandemic itself, pretty much a 10, 12-year lull, I would say, in the overall strength of the labor market, especially for those who are actively looking for work. And we continue to hear, Allie, this low hire, low fire sort of environment.
Yeah, that's something that Jerome Powell has stressed continuously. It's also younger workers, college-educated workers. The unemployment rate for that group rose above 10% for the first time since before the pandemic. Black Americans also struggling as well. So even though we have stocks at record highs, in a lot of ways, the economy is softening, and you have this bifurcated U.S. consumer. You have the higher income earners that seem to be doing well, lower income struggling under the weight of higher prices. Even though we haven't fully seen the impact of tariffs on certain goods, you are still dealing with inflation that is above the Fed's 2% target at a time where certain people are struggling to find a job. And that's something that the Fed has continuously talked about, has mentioned that they're focused on the labor market, because once that starts to deteriorate, then you risk the growth side of the equation falling apart as well. And then you get into that tricky stagflation environment. That's that scary word that no one wants to hear. So there's just this tension for the Fed with their dual mandate. And it seems like right now they're very much prioritizing the labor side of the equation. And even though Wall Street strategists are really saying to look through a lot of these shutdown risks, we know historically that doesn't tend to impact the economy or the stock market. It does muddy the data a little bit, and the Fed certainly needs clean data heading into the back half of the year if they're going to deliver those 2 rate cuts that are expected.
All right. Dollar in the jar. Allie Canal says stagflation on the program. All right, before we get out of this segment, Omar, I want to ask you a little bit about fixed income. We spent a lot of time today talking about stocks, about news of day, and fixed income in the context of that bigger picture. Fed is easing. How far they ease, how long they ease, we don't need to worry about that. We know where the direction, where they're headed. How are you seeing the setup for investors around the fixed income piece of the portfolio, again, wrapping up the quarter, heading into the end of this year?
Absolutely. Fixed income is interesting. I probably took me another like a decade to actually say that. For a long time, fixed income was not interesting, and now it is. I think a big part of the discussion we have had with clients, includes the fact that we expect the yield curve to continue to get steeper. The short end of the yield curve usually is determined by Fed policy. And we know that the direction of travel for that is going to be for the Fed to continue their easing cycle. So we expect that lower yields on the short end of the curve. At the same time, expectations of inflation and expectations of just the fuel deficits and uncertainty around government deficits tend to drive what is the long part of the yield curve. So that steepening is something that we expect to happen, which in certain way is something that we have been working with clients for the entire year. We also expect, because the economy is expected to slow down at least into the end of this year and into the first quarter of next year, we also expect that the level of quality that you need to have continues to just be a big part of our strategy. So, it's steepening of the yield curve and then moving duration a little bit to the middle of the curve while still maintaining a higher levels of quality. There is no reason why people need to go too much into high yield or too much into credit where they can still have attractive yields as the Fed continues to ease there. So there's still very attractive yields in that middle part of the curve that people can take advantage today.
All right, Omar, Ali, Inez, stick with me. Coming up on the other side of this break, we're going to talk about those battered consumer staple stocks, plus looking ahead to the biggest risks to the market rally in the fourth quarter. That's next on Opening Bid. All right, let's take a look at our sector of the day today, and that is consumer staples, the only S&P 500 sector in the red for the third quarter, off nearly 4% in the last 3 months. So what does this tell us about the market, about the economy, about the consumer? Still with me, we have Omar Aguilar, Ali Canal, and Inez Ferre. So Omar, let's go to you on your view around consumer staples, and I guess just when you look at both that sector and the broader sector action in the third quarter, how you're seeing the markets turn as we moved through the summer. And I think investors started to kind of move on from that tariff, that headline-driven market that we really seem to be living in the first half of the year.
Yes, the main thing about consumer staples and in general what is called the defensive sectors like healthcare or utilities and staples is, they provide a stability, and each one of them have different mechanics on how they generate earnings and how to generate, free cash flow yields. In the case of consumer staples, I think the assumption of investors so far and what we saw in the earnings in the second quarter, was really more related about, the levels of yields and margins got compressed and then go down in through their long-term trends. And a lot of that was a result of the assumption that tariffs will probably have a significant impact in their inputs, whether or not some of these consumer staples company needed to bring some of their supply chains, and that could potentially increase their cost, in areas where, they don't have big margins to support it. So the assumption, behind the performance was that the levels of free cash flow yield will continue to deteriorate as margins, get squeezed, because of the potential supply chain disruptions or increased cost. So that's a little bit of what is going there. And in many cases, they tend to have a premium in periods of high volatility or sentiment being down. We saw a little bit of their good performance early in April, but since the market took off after that, I think we have seen that deterioration as other parts of the sectors like technology have provided that stability with attractive yields, with attractive margins.
And thinking about, Inez, that yield component of the consumer staples trade and where you see that in other sectors, it makes me think of utilities, which has been a strong performer. And I know you've written about a few different energy plays within that context, that it's really become an AI trade now. So you get some of the yield, but then you also have this other component bolted on to what's, typically thought of as a more defensive and frankly sleepier part of the market.
Yeah, 100%. Utilities definitely benefits from lower yields, and it is part of the AI trade because you do have this whole infrastructure grid upgrade that is happening, and that is touching the utility space. It's also even touching the energy space, which energy was up last quarter as well. So when you're talking about the AI trade, you're not just talking about the data centers, but you're talking about all the energy that is going into the data centers. You're talking about uranium for nuclear plants. So all of those parts of the markets have seen the price of these stocks going higher. You've got GE Vernova, you've got Constellation Energy, Vistra. You have all of these stocks that have gone higher because of this play. And Wall Street still expect this to be bullish. I mean, the next big trade that Wall Street is talking about in conjunction to the AI trade is this energy component, the electrical grid upgrade component of that trade.
Yeah, I've got our colleague Jake Conley hounding me on a story around energy trading within tech companies. I know I've seen a few of those around, so maybe that's the next leg of this. All right, let's turn now to our question of the day, and that is on this final day of the third quarter, what are the biggest risks that investors need to watch out for in the fourth quarter? Let's just say the biggest things. Maybe it doesn't need to be a risk. Ali Canal, let's start with you on as you kind of take a lay of the landscape headed into the end of this year. Things that are standing out to you, conversations that you're having, areas that folks are either looking for opportunities, as Inez was just talking about, utilities, other places, or things that draw some concern with the S&P on track for yet another year of double-digit gains, at least through the first 3 quarters of the year.
Yeah, the S&P has done incredibly well. There's obviously a few components that we've been talking about throughout the show as to why, big tech being one of them, the resiliency of earnings, and also the start of Federal Reserve easing. So I'm very curious about the Fed in the fourth quarter. Will they deliver those 2 rate cuts as expected? There is some commentary out there. Ed Yardeni, a friend of the show, he's talked a lot about how the Fed does not need to cut rates in this current environment. And if they do, they risk a melt up in stocks. And what happens when stocks melt up? There's usually a crash that comes shortly after that. Now, there's others on Wall Street that feel as though the Fed is supportive of these current valuations, and that's only going to fuel higher highs as we head towards the end of the year and into 2026. So if the Fed does not cut interest rates by, 50 basis points in totality, what is the reason behind that? Is there a surprise surge in inflation? That's something that I think the markets could be spooked about and create a little bit of volatility, especially since markets are really banking on these rate cuts and the continuation of Fed easing. We've already seen mortgage rates come down pretty significantly from the start of the year. We know that a lot of buyers have been priced out, locked into these lower mortgage rates. So from a consumer perspective as well, a lot is riding on what the Fed continues to do in the future. So my eyes are on the Fed.
All right, Omar, as you think about the fourth quarter of this year, I'm also curious, just from your team's perspective, at what point does the attention start to really turn to the 2026 outlook? My recall is that these start rolling in sometime around Thanksgiving, maybe a little bit before. And just how are you teeing up these final 3 months of 2025?
Yeah, looking ahead, it's always a good opportunity to set up. We like to just stack this 6 months period where, team positions portfolios just so that we can look at where things will go and the opportunities that we may see over the next 6 months. Interesting enough, as we see the end of the year and we prepare for, the beginning of the fourth quarter and going into 2026, we see the potential risk associated with, an economic slowdown that everybody has talked about. In combination with higher inflation rates. So I think sticky inflation was something that obviously everybody expects to continue to watch very closely as we see the effect of tariffs that usually take 18 months to hit, where we see the ongoing, situation with price increases as well as generally just trends in inflation that are beyond what the Fed expected, in combination of a further slowdown of the economy. That could bring a lot of volatility in the market, especially when you have a market that is already over their averages in terms of valuation. So that volatility is something we expect for this end of this year. But if we get past that, what we expect to happen is the big possibilities is that we have an increase in capital expenditures across the market. We have seen a little bit of that slowdown on CapEx at the beginning of this year that we're starting to see companies start to deploy. And that CapEx, tends to realize in future earnings. We see the possibility, of course, as the Fed, reduces rates and goes into their easing cycle, that could benefit areas like small cap, that could also benefit areas on cyclicals that have been out of favor. And what we really are, looking into more closely for 2026 is that rotation away from the top heavy Max 7 into other parts of the AI trade, as well as on other parts of the market. So that increased breadth, is something that we look as possibilities going into 2026.
All right, Inez Ferre, you'll have the last word. One thing we have not discussed today, gold.
Gold, that's right. Gold with its record rally this year, and it's up 45%. Look, the dollar is something that you'll be wanting to watch out for going into this next quarter, because the dollar has been so supportive. The declining dollar has been so supportive of this gold rally. I'm also watching, though, crypto, because gold's rally tends to front run crypto. And October tends to be the seasonally the strongest month for Bitcoin. The fourth quarter tends to be also seasonally the strongest month for Bitcoin. Having said that, we did see some volatility in September, but for Bitcoin, Bitcoin is actually set to end the month higher by about 4% for Bitcoin. So that raises the bar for October for the Bitcoin expected rally, but we'll have to see. But definitely gold tends to proceed. We'll see if the crypto bulls are correct with the fourth quarter and the crypto space.
That's right. It's called Uptober, actually. So we'll keep that in mind as we get into October trading tomorrow morning. All right, Omar Aguilar, Ali Canal, Inez Frey, thanks so much for stopping by the opening bid roundtable on this Tuesday morning. Coming up, Yahoo Finance's Market Catalysts. We bring you the news behind the market moves for the trading day. You won't want to miss it.